Hello and welcome to Property and Banking webinar. My name is Salesh Chand. I'm a chartered accountant in public practice, and today we'll be talking for about 60 to 90 minutes, depending on the feedback we get from you guys. Format of the presentation, so it's pretty casual. Feel free to ask questions, and we'll answer them as we go. You can type in your questions, and we'll probably stop the presentation and answer them, or we'll type the answers back to you. We'll also give you opportunity to ask questions at the end of the presentation. We'll hang around for about 20 minutes and answer as many questions as we can. We'll also run live examples of smart banking strategies and banking products that GRA and KPM clients use to grow their portfolio. Now, KPM, Kris Pedersen Mortgages, they're also known as KPM or Kris. So I might be referring to Kris or KPM throughout the presentation, but I'm referring to Kris Pedersen Mortgages. And lastly, we'll try our best to make the presentation entertaining for you. So hopefully you'll enjoy it. Just a quick background about me. I'm a chartered accountant in public practice. I'm an active property investor. I buy and hold assets. I do cash flow investing and land banking assets. I also invest funds into trading activities where you buy, do up a house and on-sell them for profits. I'm a partner here at GRA. Currently, I have 18 years of experience in property accounting and in business accounting as well. In our whole portfolio, as of today, we've just got over 60 rental properties. Now, these are our long-term holds, and they're generating cash flow positive, and also their land banking assets. So if I subdivided these properties, we'll probably end up with 300 sections. So this is the beauty of holding properties with big sections. And I chase this kind of assets. I buy them all the time, and I get my client base to buy assets like this all the time. Also, we are in the process of finishing our 17 new build houses, and hopefully this will be done by January or February, and then we'll start building on our 6 standalone houses. What I've run out of in Auckland is enough properties to buy at the moment. I can't find good development sites, so I'm always hunting for them. And I'll give you more ideas as we go into the presentation and more banking ideas as well. Just a bit of background about GRA and what we do. We are literally a bunch of good accountants, good, solid property accountants, right? We do tax advice for clients. We give you bespoke tax ideas. We show you how to minimize your tax and things like that. We also provide you business advisory services. This is where we do your GST, your tax returns, your financials for the banks or your creditors. We also we also help clients with liquidation or insolvency process. So if your business is not able to pay its creditors, we'll help you through that process as well. As being part of GRA, we introduce you to insurance brokers, and I'll give you more details about them later in the presentation. One of the things we do is we literally send all our clients to KPM or Kris Pedersen Mortgages, and this is where they get their funding put in place. And we're going to show you the products that I use, Matthew Gilligan uses, Kris uses, and our businesses uses to grow ourselves, including our clients as well. And we'll show you what other firms use for their clients and what we use for our clients. We also have property advisory and education, so we are quite heavily involved into property education. We like our clients to understand what property investing is about, what wealth creation is about. I'm a big time believer in property investing. I believe wealth is created through property investing. And it's quite sad to see in the market the young people are not getting into properties. They should get into properties because we're just going through a cycle. Once we're out of the cycle, it's all goes upwards. We have 2 bad years in properties. We have 8 great years. So we're out of the 2 bad years and we're into great 8 years now, and the property market is doing well at the moment. We also do asset planning. This is where we show you how to protect your family home, how to protect your family members to make sure if something happens to you, what kind of documents you need in place, such as wills and memorandum of wishes. We put your family home in a trust, and we also look at protecting your business. If you've got a great business, we'll show you how to protect your business to ensure that creditors don't get their hands on it. We also safeguard your commercial properties and your rental investments as well. So this is some of the products we offer, but today it's all about property and banking. And we've got some amazing products to show you and some ways to save interest cost and how to use the banks to your advantage. Now, guys, if you do need an initial meeting with GRA or with Kris Pedersen Mortgages, what you can do is scan this QR code. I'm going to show this code later as well, and fill out the form, and we'll make sure you're booked in for one of the free initial meetings. Now, the free initial meetings is only available to non-GRA clients. This is the meeting where we cover asset protection, we cover tax planning advice and accounting services as well. Asset protection means structures, like what kind of structures you need, and based on that, Kris will help you get your mortgages and ensure the right banking facilities in place. If you need something else or other property advice, we have Maggie and Thane joining us today as well, and they can help you implement the right property advice or right strategy you should be following. If you need anything, if you're unsure, just email Amy and she'll make sure you get to the right person. So here's our details, guys. You feel free to take a photo of this or scan that QR code and book yourself into one of those meetings. Just a quick market update regarding properties, what's happening out there. I obviously, every presentation, I like to talk about the current property market. We don't really see discounted properties anymore. We saw them probably 6 months ago. At the moment, we can't find discounted properties. There seem to be multiple offers as properties are being auctioned. Interest rates are tracking downwards, and I personally believe interest rates are going to go down quite a bit. Now, I'd love to get Kris's input on this later in the presentation. What I'm also noticing in the market is there's a lot of new buyers qualifying for home loans or investment property lending as well. And this is again a sign of credit getting easier to, and people are getting their finance. And when you have a good business broker, mortgage broker, sorry, when you have a good mortgage broker, they'll help you get funding. And I'll show you what Kris has done for me later in the presentation. I've also noticed a lot of houses have started selling. I've been driving around West Auckland, Central Auckland. Nearly 95% of the houses have sold signs on. So properties are moving, stock is moving fast. Property traders are back in the market. I can tell you this now. If you're selling do-up stock or you're selling some sort of discounted properties, the chances are property traders are going to snap them up straight away. There's a lot of property traders out there in the market. We need property traders because the advantage of property traders are they buy houses, they spec them up nicely, renovate them, put new stuff in, which is quite expensive. And in some cases, property traders do lose money on their trades. But property traders are so important to the market. And Kris will tell you, if you are a property trader, how he can get you some funding. International students are back, right? So we've got international students back in numbers, like pre-COVID numbers, which is great news. We love international students in this country. They spend money on accommodation, they spend money on food, they go out and work. So we need international students. They come here and study, they spend money on fees. So we need them in our economy. We need to make sure there's lots of international students coming into the economy and helping not only the property market, but every other business that exists. Now, guys, this is a photo of our auction room. And this is a photo I've used in my last presentation as well. So in February 2023, the photo on the left was taken by me. I took that photo. And on the right is a photo taken by one of the agents in October 2025. You can see it here. You can see in the right photo, there's not even a seat available. It's the same auction room, right? There's not even a space available for people to sit. The auction rooms are getting busy, guys. So make sure your funding is in place. Make sure you're ready to buy some good properties. And if you ask me when is the right time to buy a property, it's never. Because every time I've bought a property, I felt like I paid too much. So you need to get out there and start buying if you are buying properties, because it's only going to get more expensive. And there's more people moving into the country as well. So guys, this is where I talk about intergenerational wealth. In 2007, I had about 47K of debt, and I still remember what the debt was made up of. I owed 30 grand in student loan. I borrowed $16,000 to buy a black Ford Falcon because I live out west, so you've got to make sure you have a nice black Ford Falcon. Once I bought the car, I realized I needed some black wheels, so I borrowed another $1,000 to put some black mags on, so black on black. And all my friends used to call me the Night Rider. So that was my black Ford Falcon with 47K of debt in total, 30K student loan, 15K on the car, and 1K on the mags. So you can imagine I had to borrow money to put mags on as well. And what happened back then? I met Kris. This is when KPM started. So Kris started his business in 2007. I met with him, and he was giving me advice. He was like, "Mate, you should borrow money and buy houses, and borrow money and buy. It took me a while to register to what he was saying. Him and Matt kept saying to me, like, go out there and buy houses and we'll fund you, we'll find you ways to fund you. 2010, I bought my first property, right? Today, in our whole portfolio, we have over $50 million of property assets. Now, I can tell you this, I always get people saying to me, oh, you must be highly geared, etc. Well, I'm not highly geared. I can tell you this now. Also, in our portfolio, we have about $10 million of cash, right? So it's a wealthy portfolio. We do go out and buy properties cash. We don't need finance. And who's the guy who's put all this in place for us from day one was Kris Pedersen, KPM. Now, he's one of the most important ingredients or most important part of my life. And you guys would have heard me talk about it earlier. Once you find a good banker, you're married to them. So I'm kind of married to Kris, but I'm the husband here. Kris is the wife. So I'm married to Kris here. So we are still married. He's still funding me in 2025 all that time. We catch up. We talk about funding in that. He does get annoyed now because our portfolio is quite cash flow wealthy. We don't need him as much. But, he's a good guy and he tells me what the products are out there in the market, what products I should use. Remember, guys, it's just not about borrowing money, right? That's what you don't need a broker for. What you need a broker to do is tell you what the products are. There's so many products out there that you can use, what we're going to talk about, what I use, what Kris uses, what Matt uses, and what our client base uses. And it's coming in a sec. And there's certain products you can use to reduce your interest rate to 0%. And I'm going to show you a live example of that with Kris. So, you can, based on our portfolio, you can see we're not talking pokies here. We are guys, we know what we're talking about. I don't know if we're smart guys, but we're using the products to our advantage to make sure we have a good portfolio. My portfolio is cash flow positive as well. So I pay lots in tax. So how did I get started? I built up my portfolio by teaming up with my friends. Matthew Gilligan was the first guy I teamed up with after talking to Kris, and we all got together. And Kris was the funder. Matt and I did all the JV. So we used equity and our JV money and lending. Kris Pedersen was our mortgage broker, and he helped us with all the funding, introduced us to all the banks that we still work with now. And Kris also helped us with combined resources like skills, capital, and time, and what kind of products to use. So he's very skillful. You need to use Kris to your advantage. We combined our incomes to qualify for loans. Again, Kris guided us through this process. He told us how to use our income to get maximum lending. We had to prove ourselves to lenders. So once we got the process going, and and the banks believed in us, and again, Kris's help, everyone backed us up. So it's very important, guys, and I've said this in my past presentations as well. You've got to work with the right people. Once you have the right lawyer, the right accountant, the right mortgage broker around you, you will do well in your life, right? And property is about intergenerational wealth. You'll do well, you'll pass it down to your kids, they'll do well, or you'll teach them the knowledge. You'll give them all the supply chain you have, and they'll use it to their advantage and they'll grow their wealth as well. So guys, and this is something else I use all the time in our presentation. This is a roadmap. Okay, so this is a roadmap of what you should do. There's 7 steps. And I want you to take a photo of this and use it to your advantage. Work out where you are, right? That's important in life. So some of you might be doing really well. You've got a beautiful home, you've got a nice mortgage, and and mum and dad working. That's fine, right? There's nothing wrong with that. You're doing amazing. So work out where you are, and then you work out where do you want to be. And when we say work out where do you want to be, where do you want to be in 10 years' time? In 10 years' time, you might say, well, our kids will live home. We want to have a nice house in Auckland. We want to have a badge. We want to have a boat, a couple of cars, to go backwards and forwards, and maybe a $40,000 a year in holiday, right? And this is what people want. This is generic stuff that people want. So there might be $4 million of assets that right? So you work out where you are now, where do you want to be in 10 years' time, right? And then what we do is we have a product called Wealth Sweat, right? And if you fill out those forms, first 5 people, they fill out those forms, I'll give you the software for free for 12 months, right? And I'm giving stuff away for free, not because I want your business or something. I want to promote property ideas, right? And I've done this before and it's helped a lot of people. So Once you get wealth suite, you can then put your affairs in there and see what you need to do in your life to grow your affairs, to grow your wealth. Then you get the right knowledge in place. This is really important. You hang around with guys like GRA, you hang around guys like KPM, Kris Pedersen Mortgages, and you get the right knowledge in place. And if you hang around with us, we put you through property school or development school, right? We give you one of those. Now, property school is really important, guys, because this is where you get taught about property investing, about funding, about the supply chain that we use, people over here at GRA use. So you get a strategy in place. Like, what do you need to do? If your debt level is too high, we talk about reducing your debt level. Or if your income is too high and your debt level is too low, we come up with plans, right? So this is where you have a strategy advice. You can use Maggie, Than, or you can use any of the GRA consultant. Get your structures set up. Now, this is something that Kris will touch on it later. The amount of time the clients have gone out there and got their pre-approval, but not their structures in place. What's happened is, as a result, they had to reapply for funding because they didn't have the right structures in place. So it's very important we get the right structures in place and set up. And we can do this for you. We'll make sure the right structures are in place, the right mortgages are in the right place to get maximum tax advantage. Then we arrange finance with Kris. We'll work with Kris all the way to ensure that your finance is arranged. And you will meet Kris today, so you don't have to go through property school to meet him. You'll meet him today. And then you purchase, right? You buy the property, we settle it. I think we got about 2 or 3 settlements happening tomorrow. So, it happens because we've been working through with the lawyers and Kris to make sure the clients are using the right structures and the right tax advantage in place. Now, if for any reason you get lost through the process, you have people like Kris, you have people like GRA who will hold your hands and make sure you get the right outcome, right? We will not push back. We'll hold your hands. Now, Kris, you there? I'm going to get Kris to come on board now. So Kris is about to come in. Kris hasn't been feeling well, so he's just woken up in the last half an hour or so. But guys, he's got some amazing things to talk about. Kris, do you want to take over?
Thank you, mate. Thank you. So I'll apologise up front. I played golf with my 15-year-old on Sunday and he was coughing all over me and I picked it up. So apologies if I've got to pause for a second to do the same thing. Now I'll start off with a bit of a introduction on myself and I suppose how I happen to be here. I just want to clarify that I'm definitely the husband and Salesh is definitely the wife. He's getting that part wrong. So my story probably starts the best part of a quarter of a century ago. I was at a property seminar at a company called Rich Mastery, which was a big property education thing back in the day. And for those of you who know who Matt Gilligan is, he was actually speaking on stage then. And I don't know if Matt's ever had hair because he definitely didn't have any hair all the way back then. So I went along to this. I kind of fell in love with the whole idea of property. And I think like most people who kind of come through the school system, which is designed to make you better at things that you're not necessarily good at, I started kind of probably trying to do a whole lot of stuff, so I gave property trading a go. One of the things I learned very quickly is you don't want me renovating your home. I'm more likely to devalue it than add value. But I was working in finance at the time. It wasn't property finance, it was consumer finance, which is dirty, and wanted to learn more about property. So after a couple of years, I joined a non-bank lender. And these were the types of lenders who were doing all the kind of mortgages that the banks wouldn't do. And it was a pretty loose time back then. To give you an idea, the company I was involved with, we got up to doing 112% mortgages. We got up to doing 95% mortgages where you didn't even have to prove income. And you can kind of see probably why we ended up with something a couple of years later called the global financial crisis. And I remember kind of getting to that stage, and at that stage, there was money everywhere. I remember making a cynical comment back then that if you had a pulse, I could probably get you money. And then I think towards it was about 2006, I actually managed to get funding for an estate. So you didn't even have to have a pulse back then for me to get you a mortgage. Now, I think it must have been about 2008-ish. I ended it. Well, a couple of things. I remember back then, kind of getting to know Matt well and kind of getting to know him. And he taught me a few things. At that stage, the market was very relaxed, and it was very easy to get money. Banks were being very, very nice to people. And I suppose what I've learned over time, a bit of a saying that banks like giving you an umbrella when it's sunny and taking it away once it starts raining. And that's definitely something I've seen, I suppose, both through the GFC and not as much. The banks are a bit better than what they used to be, but to a lesser extent in the last few years. where in times where the property market's going up, they can throw cash out kind of very, very easily. But when basically the property market starts coming back, they can start becoming, a lot harder to deal with. So basically, since setting up as Sal said in 2007, kind of growing KPM, we're the principal sponsor of the Northland, Auckland and Southland Property Investment Associations. If you pick up the Property Investor Mag, I tend to write the articles in regards to interest rates and answer the mortgage questions. As I said before, I've kind of been investing myself for over 20 years. Second of these. And so where I always start is something called the one bank trap. And again, referring to Matt Gilligan, it must have been about 2005. He was the first person to teach me this concept called split banking. And most people basically immediately, but I was talking to a lot of investors at the time, thought that this was basically a case of overcomplicating a setup. But definitely what I've seen through both those downturns that I referred to before, there's a lot of happy clients who basically happy with GRA, KPM over time for using a good split bank strategy to basically set them up. So, 1 second. So what we've seen over time is standard basically debt structuring. A lot of people do something like this, where they might start off with personal home. You can see that on the left. And often what's tended to happen is people basically go back to their personal banker. Banker basically looks at their position. They've got a bit of equity, and they used to use the term, will 100% finance you into an investment property. So what we saw over time, a lot of investors grow portfolios like this. And what it was not actually true 100% finance. It was using the equity that had basically been growing basically in other properties to effectively allow the investor to continue to purchase. But what was happening behind the scenes is the banks link basically all the mortgages and the properties together. And again, as I basically alluded before, when times get hard, that doesn't tend to basically be the best setup. So reasons why cross security is not a good option. If you've got all debt basically held with the same bank, I mean, if you know Gilligan Rowe, they're very basically good at explaining how to use asset planning as a way of setting up to split your basically property ownership and ownership of other structures. What we unfortunately see is a lot of people who go to the effort and the expense of using different entities to basically get set up, and they give everything to the one bank, and they're effectively exposing everything to the largest creditor. Something else we've seen is banks often change criteria over time. So I can vividly think of a client a couple of years back who had a number of properties with a certain Australian bank. I won't name them. And one of the properties they basically had was a block of flats, and they'd put into social housing. And this bank basically, now the investment actually improved by them putting it into social housing, but suddenly they had no vacancy. They were getting higher basically guaranteed rent to what they were getting basically previously, but suddenly the bank wanted to basically treat them as a commercial client. And really, they got very, very stuck for a while, and it took quite a while for us to be able to unwind them. Some other things that we've very much seen in the last few years where this is not a good way to go is interest only. Now, especially when we went basically through COVID, obviously interest rates went very, very low. And when basically interest rates started to rise, a lot of people wanted to basically kind of roll over interest only periods to basically preserve their cash flow. And what started to happen is a lot of banks were making clients go through a full loan application process. And if you couldn't meet their current criteria, they were forcing clients onto principal and interest. Now, if you think about this is not common sense. Basically, they're putting you through an application and basically saying, if you can meet the affordability criteria, we'll let you pay less. If you can't meet the affordability criteria, you'll pay more. Obviously, not much common sense there. Now, I do think it was the Reserve Bank who regulates all the banks who was potentially pushing that behind the scenes. We're starting to see a little bit more relaxing, thankfully, in that area. After being very tight, we've now seen a couple of banks come out recently who are doing 10-year interest-only periods again. So that's positive. But another big reason why we've seen where you want to be careful cross-securing properties basically with one lender is if you look to basically sell a property. And especially for those of you who might be online, who might be getting a bit older, often what we see is, people, especially those investors who may be kind of more focused on capital growth areas like, Auckland, maybe Central Otago. Often what happens is people buy more properties than they're planning to, have some mortgage debt. Then what their plan is over time is to sell a property, to look to reduce debt, get there some hands and some cash, and go from there. Now, previously, what happened is if you had more than one property at one bank. And if you look to basically sell a bank, retain a property, and retain debt there, the bank would basically let you retain that property with debt up to the maximum loan to value ratio at the time. Now what's basically happened across most banks is if you go sell a property, again, what they're wanting you to do is basically, and again, if you're retaining a property and debt after the sale of that property, they're wanting you to go through a full loan application process. And if you can't basically meet the current criteria, the bank's been taking all the proceeds. So what we've seen quite a bit, probably kind of 23, 24, 25, obviously there's a lot of people who got hit with, large kind of increases in interest rates, is people look to maybe sell a property because what they were trying to do is, get their hands on some cash and basically kind of get through what's obviously been a pretty painful recession for some people. Unfortunately, what was happening, they go sell the property, bank would take all those proceeds. So again, this is a type of setup where Sal and I do a lot of work together, and he's very, very good at it, as are the rest of GRA. For wherever you're at probably in your investing cycle, whether you're basically just starting off or whether you're maybe kind of heading into retirement and stuff like that, you want to basically understand, any negative implication in regards to, do you need to basically retain interest only for your own cash flow moving forward? If you go sell a property, are you going to be able to meet the criteria? And, if maybe that's going to change if you're heading into retirement, should you be refinancing and split banking before you head into retirement? Things like this. So another comment I was going to make is banks treat some properties differently. So what we often see is, especially people who have been very loyal to one bank, they can just go straight back to the bank thinking that a bank's a bank's a bank and they're all basically the same. Now, this took me 2 minutes on basically Trade Me yesterday, just to kind of give a couple of quick examples. The top left apartment blocks, 38 square metre apartment. Only one bank will basically treat that as a standard investment property, which means they basically lend to 70% on it. Pretty much every other bank won't lend on that because it's too small. Or, you might get exceptions, but you'll find that banks will be quite difficult on it. The block of 3 off to the right of the apartment block, for example, there's one bank who would treat that, if it was on one title, as a commercial property. That basically means you'd pay significantly higher interest rates. That means your loan term would be basically a lot shorter. That means that basically you might be getting reviewed quite often. Not an ideal situation when you're trying to get the best return on your investment. Bottom property, again, let's say that was 7 units on one title. Most banks will basically treat that as commercial. Something we've very much seen probably in the last 12, 18 months is blocks of flats kind of went out of fashion when Labor changed the rules around the interest deductibility. And what we basically noticed is that, their prices got very suppressed through there, but the yields on some of these properties are actually quite good. So we've noticed some of our more sophisticated, longer term investors going back into these types of property because they can be quite a good investment. But again, to give you an idea, pretty much all banks would treat that commercial. We've got one bank who should definitely treat that as residential and one other who would basically consider it. So just to reiterate, let's say you've just got a relationship with your bank, you go to them and you're thinking that they'll basically treat all properties the same. You can see here quite clearly, especially when you get into a more specialist property types, there could be kind of large differences from one property to another. Now, something that I see often, obviously kind of doing a lot of work with GRA, and again, probably 95% of the clients I work with overall are property investors. So it's very common for us to basically see clients who are using entities, trusts, look-through companies, investment trusts, this type of setup. And one thing we see often is clients who basically confuse the tax and the finance setup. So this is quite a common setup we see where you've got the family home and the family trust, maybe a few investment properties in the look-through company. And basically over here, the client basically looks at it and thinks they've got all debtors basically through the look-through company. So that's fine. It could be a really good tax setup. But the part they're missing is you can see here, ANZ's also got a hook on their home. Now, the way they look at it is because all of the debtors through the look-through company, they don't actually realise that basically the bank also has a hook on a home and they've effectively got all that cross-secured. So a lot of basically what we'll look at doing, again, you want to take advice from GRA to make sure you're doing all of this correctly. But what we'll often do here, give me a second, is look to basically try and pull the home out. And at the moment, the maximum you can lend on an existing investment property through the banks is 70%. So just to go back to the previous slide, you can see here if you've got everything through the banks, you can see here that you might think you've got 80% lending, but effectively what the bank's done is because they've got the family home in the loop, they've got everything cross-secured. So sometimes what we will try and do is pull the home out. Yes, that will mean it looks like there's basically debt being put on the home, but you need to understand that basically it's already there because of the cross-security, and we take that away and we put that with a different bank. So you can kind of see here that basically the investment properties previously looked like they had 400K on each. Now basically to move away, we've got 150K on the family home, but the benefit is basically if anything went wrong, ANZ is carrying the majority of the debt, and if you do things correctly, ANZ can't get back into the family trust and the family home. Now, something which is a little curveball, which we're having a bit of success at the moment, is something called a dollar for dollar exemption. And effectively, the Reserve Bank rules that they limit basically how much banks can lend to borrowers with low equity. So at present, the existing investment lending is mainly limited to 70%, but there's this dollar for dollar rule, which means the exemption means that if you simply want to switch your existing mortgage balance to get a better rate or term, then the new bank does not have to apply the loan to value ratios. So as an example, if I go back just a couple of slides, and let's say I look at basically One Investment Street here, let's say you bought this property for 500K back in 21, which is roughly the peak of the last property cycle. And let's basically say this was a standalone property all by itself. And let's say it's gone back, back then, actually, sorry, I'll use this example. This one here. So let's say basically this property here, you bought it for 500K, you've got a 70% mortgage on it. So basically you've got a 350K mortgage. And let's say the property market's pulled back 10%. And so that property is only worth 450K now. Even though it's above the 70% LVR, if that property was standalone and you didn't have the other debt there, you could refinance that from one bank to the other, basically, and it's exempt with the LVR rules. So the reason I'm trying to explain this, it's a little bit technical, is we're finding a little curveball where in some cases what we can do is refinance properties which are above the 70% LVR. They're cross-secured potentially into things like the family home, and we can refinance them away and keep them at 80% LVR, even though it's above the current loan to value ratio limits. So again, just to kind of go back, because I just want to reiterate this. Oh, one sec. So this here, as an example, ANZ is going to look at it like they've obviously got the home and 3 rental properties as security, and they've got $1.2 million of debt. But if I was basically doing a refinance application, I might better refinance it and say, I'm just refinancing these 3 loans here on a dollar for dollar, basically exemption, and I'm not offering up the family home. And then basically the other bank just sees, okay, these are 80%, we're doing a dollar for dollar exemption, and we effectively leave the family home behind. In doing so, you can effectively get a higher LVR than basically what you can normally get. Key factor is you cannot borrow any additional funds. As soon as you basically want to borrow another dollar, the exemption doesn't apply. So split banking strategy, and this is, I suppose, an example of what Matt taught me back in the day, and I mean GRA and KPM very much basically work off the back of this, is what you try and do is generally raise a revolving credit facility. We'll get into those more in a bit more detail shortly, against your home with Bank A. And then what you're trying to do is basically raise as much debt as possible through other banks. So you can see here, number of properties, banks B, C, D. In some cases, you might decide to have more than basically one investment property down here, but we don't want to be basically cross-securing the investment properties into the home. Obviously, if you're looking to basically build up a substantial portfolio, you're going to run out of banks. So the key factor is continuing to basically keep the equity back in the home, raise as little deposit as you can from the home, and then basically raise the remainder from the investment lenders. Then ideally what you should be doing is looking to basically buy at a discount. If you understand what basically Sal was saying previously, we kind of noticed probably last year there was definitely kind of more discounts than basically we're seeing at the moment. There's starting to be a bit more demand in the market. But basically in an ideal situation, you should be trying to basically buy at a discount, add value through renovations. And while I don't think we're going to see the crazy capital growth that we saw back prior to the GFC or in COVID, we should get some kind of capital growth in the next few years. And so ideally then what you can do is basically go back and look to top up with the banks down here and pay that equity back to the family home. So something which is worth trying, and you'll note that I had mentioned 80% LVR there. The Reserve Bank, which regulates all the banks, has recently come out and they have announced that from December 1, the banks are allowed to do some investment lending above 70% loan to value ratio. So we don't quite know how this is going to play out. So with the loan to value ratios, effectively the banks were to an extent able to do what they wanted basically prior to 2013. Since then, what we've seen is a continual change, especially in the investment market. The owner-occupied market has been pretty consistent. But in the investment market, when things are basically slow, the Reserve Bank increases the loan-to-value ratio that you can basically lend to. When property market starts going out of control, we've seen that number basically brought back. So effectively, the banks are going to be able to do up to 10% of their total lending on investment above the 70% loan to value ratio. For those of you, I would basically say, consider once you get post December 1, consider basically trying to top up against your rentals and basically looking then to kind of pay that debt down on your home. What will happen relatively quickly, I think, next year, I wouldn't be surprised next year if we get a little bit of a pickup in the market. There'll be more investors who are wanting to do things with a short on equity. As if you can get in there early, you might be able to basically get some of your investments to 80% before the banks run out of room, which I think they could do relatively quickly next year.
So Kris, what he's saying there is, are you talking about 1st of December this year, right?
Yeah, so 1st of December this year. So banks, the part which is a bit confusing, there's always been this 5% allotment above the loan to value ratio that the banks have been able to do. The banks haven't used it because it's too hard for them to manage. So the Reserve Bank has increased that from 5 to 10%. So the expectation is the banks will allow some people to go to 80% on investment property. How they pick this, I don't know. We've got no communication yet.
Okay, so if someone was wanting this funding, they should probably line themselves up now.
Yeah, yeah.
Get all the paperwork in, get all the application lined up.
Well, especially if your situation is you're short on equity, you know, this is basically a chance where you might be able to top an existing property basically back up to 80% to access that equity before the banks kind of run out because they don't have much. While the banks can basically do up to 10%, they really struggle to basically manage it. So while they can do up to 10%, they might do 5 or 6% as an example. It's just too hard for them to manage. If they go over it, they can effectively be basically breaking their banking covenants and all this type of stuff. So they tend to be a much more conservative than the number they can go to.
Yeah, because this is the kind of stuff I used to wait for, where you could go from 70 to 80%. I'll line it up. I'll borrow that extra 10%, and either to put it back in my working capital, and all of that, and just allowed you to release some money back out to do other property transactions. Thanks, Kris.
Correct. And one of the big things I'd say for anyone is, if you're not sure what I'm talking about, go Google the property clock. And one of the big things that we notice with things like a property clock, and Sal mentioned this on an earlier slide, is as finance starts getting easier, more people come into the market. As more people come into the market, the property market starts doing better. So we've obviously seen the Reserve Bank do two things. They've effectively reduced the deposit for some people that they have to put into investment properties. And secondly, we're seeing them continue to bring the interest rates down, which is obviously making the numbers look better. So I think the more they do that, and I think they're going to have to bring interest rates down further, I think we'll basically see another cut in a few weeks, and I'll get a bit more into interest rates later on. But I think they're going to have to bring them down further to kind of give the economy a bit of a kickstart. So for those of you, you don't want to wait too long, in my opinion, because there's a part where if you wait too long, then the market becomes a lot harder to find the good buys. Yeah. So this is something that I do a lot with the GRA team, and Sal and I work on a huge amount of clients together, which is effectively restructuring the debt and clients' shareholder current accounts. And so, Sal, you can tell me off if I don't explain this very well. But I mean, this is an actual client's portfolio that I've basically been working on in the last couple of weeks. So effectively, we probably worked on this client, Sal and I, initially, where we restructured their property, their home into a trust, rental property into a look-through company, probably about 5 or 6 years ago. And, because the clients haven't wanted to buy another property, they managed to lock their mortgages down for a really good 5-year rate, 2.99. They kind of haven't been really looking at their portfolio too much. So they've actually popped up and kind of wanted a review of the position. And so just giving you an idea of the things that kind of Sal and I tend to look at. So firstly, what we've got is a investment property where we've got some equity where we can top up and potentially put it over to the trust side. So keep in mind, you're always wanting to basically have as much debt outside the trust, as much equity inside the trust. So looking at this here and just reiterating the current rules until the change to 80%, where the maximum someone could borrow was 70% on an investment property, 70% of 990 is 693. So just to give you an idea, what we've done is we're basically topping up 93 and we're basically reducing some of the debt on the basically family home. So just to go back, you can see here, this debt's higher, topping up here, reducing debt here, but better overall kind of setup for the clients. Now, GRA, and I'll probably get you to advise the sale because you'll do a much better job than me in regards to how a shareholder's current account works. But this is kind of a standard thing which I do when I'm working with the client, touch base with GRA and going, is there any advantages in regards to restructuring some of the debt? And GRA advised that we could restructure 165. Do you want to maybe explain that, Sal?
Yeah, so what you got to understand is shareholder's current account in a company means that how much has the shareholder put in, right? So, for example, in this case, you say Chris, Chris has got his numbers here. So in this case, the property is worth 990, the loan is 600 grand. So the bank's put in 600 grand. The balance of the funds came from the shareholder, which was 165, and then whatever makes the 990 is the capital gain, right? So the shareholder over time has put in 165,000 into this company. Now, because he's got a current account balance, the company owes him this money. You get no tax advantage, right? In terms of this 165. What we do here is we approach the client, we take some money from their family or take some of their personal debt, which is non-deductible. We flick them back into the company, right? And we push more debt into the company so we get tax deduction. So this is what we call calling up a shareholder's current account, where the shareholder calls up their current account, moves their personal debt into the company and gets more tax advantage. Now, this is accounting 101. Most of the clients that we pick up, they don't do this. We instantly attack the shareholder's current account and we make sure more debt is moved into the company so the clients can get tax advantage. And look, you got to review this every 3 to 4 years. You have a good review with Chris because your property values have gone up. Put more facilities in place, move more debt into the company so you get more tax advantage. Hopefully that makes sense. But if you don't understand this, book an appointment with us, we can go through your fees and work out what we can do.
GRA is very, very good at this type of stuff. And we see a lot of clients who end up basically paying too much tax. Not talking about this actual situation here. I vividly remember when I first was on the GRA floor, I'd been using a different property accountant at that stage. And basically went to sell a property. My accountant at the time didn't raise anything at all. Happened to be talking to Sal, because I had an office a couple of doors down from him. And he goes, have you thought about this, this, and this? Basically, his advice immediately saved me 25K. I obviously fired my accountant and moved across to GRA pretty quickly. But there's a lot of people who sit there and go, that they'll basically look at the cost. I can sit there and say from someone who's worked with GRA now as a client for the best part of 15 plus years as well, they've saved me a lot more than I paid for them.
Yeah. Well, you've also got to remember, when we do client restructure and things like that, it's not all accounting. There's legal costs, that involves. So that's why people can say it can be expensive. It's not expensive. One off, and your returns are coming in straight away. It protects your family home, gives you the best tax position, and that's what you guys want, to make sure that if something goes wrong, your assets are protection. Now, I'll tell you this: if something goes wrong, it costs you 900 plus GST an hour for a lawyer. Right? You could be spending $10,000 a day on a lawyer trying to rescue your family home or your business. So it doesn't cost much to actually put the right structures in from day one. And Chris and I have worked on so many clients over the years where we've protected them or they've been in trouble where we've bailed them out.
And one of the great things at the moment, which we're doing a lot of, is cashbacks. So for those of you who aren't aware of cashbacks, to be blunt, are almost a bribe that the banks have been kind of throwing out there for a while. So this client situation here, in reality, what we're doing is we're actually, because they've been with ASB and Westpac for, as I said, over 5 years, they're outside any what's known as cash contribution clawback period, where that means those banks can come after the money. So this is actually what we've worked on and where these clients should be settling in the next couple of weeks. So because we're moving across, these two banks, ANZ and Kiwi Bank, are going to be throwing the best part of $12,500 at the clients. They will have to pay a little bit to their lawyers to basically transfer across, but they're basically definitely ending up in a much better position with cash in their pockets. And for those of you who are looking at maybe kind of using GRA services in regards to setting up entities, this is what we do a lot to basically minimize the cost of your setup. We can often go get kind of cashbacks basically from the banks. And so in a lot of cases, we've had clients who in reality have ended up with cash in their pockets after doing a restructure.
Yeah, and also you get them good interest rates once you restructure with another bank.
Yeah, obviously, key point is making sure the new lenders are fit for purpose. Going back to what I said, you don't want to just basically move around for the cashbacks and then find out the lenders aren't useful. This client situation here, Kiwibank was basically fine. The clients basically wanted an offset facility, which is basically Kiwibank's one of the few banks who offer it, and ANZ was offering a 10-year interest only basically period, so they were basically happy with that. So we made sure the banks who were refinancing to were good as well. So just going to jump into a couple of banking products and what obviously Sal and myself and the rest of the GRA team, we spend kind of all day, every day looking at people's financial positions. And often we see people who are in actually very strong financial positions, but they're just not setting themselves up as well as they could. And often that basically means that the banks, to be blunt, making more profit than they should. And just some restructuring means we can basically put some of that money back into clients. So a common setup we see is something like this, where you may have a client who's got a mortgage, a term mortgage, where they might have a fixed interest rate, and then they've basically also got some cash, maybe some cash in a check account and a savings account. You know, we've definitely got a lot of clients who have got substantial money in term deposits, but effectively what's happening is in a lot of cases, they've got all that with the same bank. So it's not unusual for us to see a situation where a client's got hundreds of thousands in saving. People often want liquidity, rainy day money, but then they still have term mortgages with the same banks. And so what we strongly recommend in a lot of cases is consider using something like a revolving credit facility. So a revolving credit facility is effectively, for those of you who aren't aware what it is or how it works, is like a large overdraft. It's at floating mortgage rates, but you effectively only pay for what you use. So going back to basically the previous slide, what we often do for a client like this is sit there and look to basically restructure the existing mortgage into something like a revolving credit facility. The client can then basically dump, basically what cash they've got into it. And if you go, I'd recommend anyone who's sitting in this position, go have a look on any of the main bank websites. You'll sit there and say, most of the term deposits at the moment are probably around the early 3% range. And, for a mortgage rate, you're paying a good 1% more than that. So effectively what you're doing is lending the bank money, they're basically lending it back to you and they're taking a margin off you. So by structuring things this way, you can get the benefit of that margin. Again, a lot of people, I think, are wary about their ability to access the money. Revolving credits are very easy to access. It's as easy to access as basically your check account. The money's exceptionally, easy to get. You don't need to talk to me as a broker. You don't need to talk to your banker. It's all basically very easily available. One of the things I will say is keep in mind that if you don't have sufficient cash resources to basically zero out the mortgage, this is where you may split the mortgage into a number of parts. So there's nothing stopping you. Let's say this client here had $100,000 of debt left over and they weren't going to basically have sufficient cash to pay the revolving credit right down. What we'd probably do is split it and have maybe say $100 fixed term loan where you can get a better interest rate and have the remainder on revolving credit facility where they can use their cash to basically offset it. And I mean, Sal, you would probably agree with me. How often are you seeing these situations?
In terms of what? Sorry, Chris.
So how often are you seeing these situations where you've got clients who are sitting on considerable cash, but they've also got mortgage debt, which they're not offsetting?
Yeah, and I'm going to answer that really well. So because we've been building our client base since 2007, I've been working with clients, and most of our clients who did property investing, and Chris will agree to that, 95% of them are multimillionaires now, right? They've got, they've bought 5 or 6 houses, they've sold a couple of houses, and they're probably sitting on $1 million cash. They've still got $1.2 million of debt.
Yep.
So our standard advice would be, I'll just pay your debt off. Right, Chris? That would be the standard advice. So what do we do here? And Chris did this for me as well. Chris will show you.
Show you an example in a second. So this is an actual client example I was working on with Sal about a month or so ago, I think it was. We had this client who was basically sitting with a bit of cash in the check account. I can't actually remember how much that was. They literally had the exact same cash sitting in term deposits, is what they basically had sitting in their mortgage facilities. And it was more a case of prudency, of concern that could the bank basically take their money and run off with it in this type of situation. And I suppose I want to reiterate that banks in previous property cycles, you go back to around 91, where BNZ was very hard on clients. You go back to prior to the GFC, where banks were very difficult. We're not seeing this. There's basically a social responsibility put from the government onto the banks now, where we're not seeing banks basically kind of call mortgages in as long as basically you're up to date. And in this situation here, we literally basically converted this client over to a revolving credit. They zeroed basically their situation out. The great position is that they've still got access to that cash for moving forward. That client wasn't too far away from like going into retirement, but they're effectively not basically, paying the bank more than they should be.
So what happens here? You achieve two things, right? You get his interest cost down to zero, right? And you still have access to your working capital, which is your 600 grand.
Yep.
It's a fantastic position to be in. And I just, and I see this probably once or twice a week from, some new clients coming board that they're not utilizing this particular product. It's so good, and we should be making use of it. So there you go, Kris.
So the big thing to understand is with a revolving credit is like a big overdraft. The difference is now every bank pretty much offers a revolving credit. You'll note that they basically love jargon. So you might hear of Orbits or Flexies or rapid repays or all this type of stuff, but every bank's got it. Not every bank offers offset facilities. So the difference with an offset facility is you can effectively connect a number of accounts. And then if you've got a floating mortgage, the positive balances basically, which are in things like savings or check accounts, will offset the mortgage facility. And so you'll only pay the interest costs on the balance. So I think we've got an example for you, Sal. Or do you want to talk through this one?
So guys, and it's very important you don't approach the bank directly. Always use your mortgage broker, because I'll tell you, every time a client approaches the bank directly, it becomes a mess, right? Because most of the retail bankers sitting in the front will just say no, see you later. Guys, here's an example for me actually, and I've got it even on my phone here. I had very nice rental property, and I said to Kris, "Can you get me maximum lending?" So he pops down. Kris goes to his mate at Westpac and gets me $1.1 million, and I'm like, fantastic. So I used the funds. Then I had some extra funds come in because some of my activities finished, so we ended up selling some trading stock. Ended up getting probably a couple of million back. And so I rang Kris and I said, I want to pay off my debt. And this is where Kris then said to me, well, let's not pay off the debt because Westpac has this facility called an offset facility. So where I get to put $1 million in a bank account, and which offsets my $1.1 million loan. So now I have zero interest cost. And at the same time, I have access to my cash, right? Which is sad for the bank because they're not making money, but they've, don't feel sorry for them. They make $2 billion a year profit. So, but it's all about us as investors getting the right products, right? Because a standard advice would be Kris could have said, yep, I'm a lazy banker. You go and pay off your loan, right? But Kris worked harder, and it took him probably 8-9 days to get me this facility. And so now I've got $1.1 million offsetting this loan, 0% interest cost since 2003. And I'm happy to bring it up on my phone as a live example. So if you see any dodgy transactions, just ignore that. It's Kris using my bank account. But apart from that, I'll show you guys so you can see what Kris sorted me out with. So here's an example of cash. Kris, can you see the bank account balances?
Yep.
Yep. So there's cash sitting in a bank account. There's a loan offsetting at zero interest cost, guys. So that's $1 million, 1.1 million or something like that sitting in the bank account. $1.1 million, I'm paying zero interest cost. And we're doing this for so many of our clients, right? This is a very smart product, guys, and everyone should use it. Now, the disadvantage of doing this, I'm paying tax, but that's okay. If I have to pay 30% tax or 33% tax on that, I'm happy to do that because I'm still saving 66, 67% of my cash flow. So, yeah.
And so just to reiterate, like I think back when first started working with Salesh in particular, especially around kind of 2010 for probably the best part of 5-10 years, one of the first things we did with a lot of people was set up big revolving credit facilities. And unfortunately, this has got harder to get in some cases. So a lot of what basically we'll do is we'll be more creative And especially for those of you who are asset rich, for those of you, as I said, who might be going for retirement in the next however many years, those of you, especially those of you who may think about selling a property in the not too distant future, that's where you want to have a talk, because we can basically do something like this and set you with a good size facility, which you've then got to move forward with. So, one of the things I often say to clients is that what's quite stupid is, let's say you were going to go buy an investment property for $1 million. You're going to put down and let's say you had $1 million in cash. You were lucky enough to basically have that. If you basically bought that property in cash and went back to the bank the following day, the bank will not give you a facility. But basically what we often do is sit there and go, okay, you don't necessarily need the debt, but basically we basically put in place a 700K at the moment revolving credit facility. You pay that down to zero, they'll let you do that at that stage. As soon as basically after settlement, you go back to the bank and try and do it, you can't get it. So there's often these key little times where you've got a purchase coming up if you're sitting on cash, if you're looking to sell a property. Maybe there's certain life basically changes where you're looking to basically kind of downsell or something like that. That's basically where kind of the review process, which Sal was talking about, becomes really important, because that's kind of one of the few times we can look to put these facilities in.
So also, I mean, it doesn't mean you have to have cash to get this facility.
Oh,
Kris
correct.
can put this facility in, and you could have a business that has a lot of cash, and you don't need the cash for, say, till the 20th of the month, or maybe the end of the month. Let's say you've got extra 200 or 300 grand. So Kris can set this up against your family home. We transfer the cash again into the facility, so you're not paying interest. And on the 20th, you need the money for the business, you flick it back into the business. So what's happened here is you've probably saved yourself 2/3 of your interest costs for the month. So with business owners, they have a lot of cash flow coming in, then the 20th, the money disappears. This could be the facility you want to aim for. Because look, guys, if you can save yourself 7-8 grand a month in interest, why wouldn't you do it? It's just the lowest hanging fruit you can imagine.
So I won't get into this in too much detail for those of you who are more interested in comparing offsets and revolving credits. I'm sure you'll get access to the recording later and you can have a closer look. This basically gives more the, I suppose, benefits and the pros and cons, offset versus revolving credit. Probably just a couple of quick points I'll make is the financial discipline. One big thing, I suppose, is be honest to yourself about your money habits, especially with things like revolving credits. Someone like Sal is actually good with his money. He's actually quite hard to get to spend money. He's so bloody prudent. I remember basically when he was looking to buy himself a new family home, and it took years and years and years to him to actually do it, because he was kind of not wanting to necessarily spend the money. Where other people, my wife for a little while, if you gave her a revolving credit, she'd be buying a new pair of shoes all the time, if that makes sense. And so you kind of be honest to yourself in regards to your financial discipline. Revolving credits, you got to be careful if spending's something you're not that good at, just having access to the funds. Offsets can be a basically better facility there. One other quick comment is a change that's happened over the last kind of few years is with offsets, a lot of the banks are making the borrowing entity a lot more complicated. So my understanding, and I could be wrong on this, I think BNZ might have got a little bit of a whack. They've got a facility called a total money, which is an offset facility, and they used to basically enable people to basically use look-through companies and trusts and all of this. Now basically they're only letting people, I think, mainly do it in personal names. This is where Gilligan Rowe's really good. They can still basically create ways where fundamentally you can put the borrowing in your personal name behind the scenes to be able to access those facilities and still tie everything basically back. So you can still access these facilities where maybe other people can't.
And what you got to realize, guys, like, banking is actually not easy, and when you have the right brokers, we make it look easy. But the amount of hours and hours of work that goes behind this, and Kris and I would discuss a file for hours and hours and getting the right structure in, the right documents in, and all of that. So sometimes, you pop around and see us for an hour, but we've probably done 8 hours of work at the back to make sure. So always use guys like Kris, very important, because I'm not a banker. I use Kris all the time. Kris will probably say I'm a half-ass banker, but, I'm not a banker at all, I don't understand banking, so I always call Kris for help.
And we very much see that when we're working with other firms. One of the big issues we'll often see is other accountancy firms may understand tax, but they may not understand the asset planning side. Lawyers, for example, may understand asset planning and not understand tax. And so often, basically, we'll sit there with clients who aren't using GRA, And we'll find that the setup can end up kind of turning into basically a bit of a mess because those people are concentrating on what their speciality is. GRA is really, really good at starting from an asset planning point of view, asset protection, and then basically making sure everything works in regards to tax. And obviously the way that people like Matt and Sal, Dan, and basically Maggie are, been kind of coming over the top with a lot of really good property advice. So I won't talk too much about this. It's more basically a case of we kind of get involved in a number of other basic banking products, commercial banking. I've got a couple of chunky clients I've been working with this year who wanted to basically buy their own commercial buildings. And we've got a couple of banks who will actually allow owner occupied, not investment, people to basically potentially buy up to 100% on commercial banking. Sal and I did a lot of work back into last year, early this year, getting a very strong client into their own premises. And they managed to get an absolute steal, didn't they? So Sal.
And see, what you got to remember, guys, is again, having the right bankers, right accountants in place. When we saw the building come up, we just knew it was a good price. We need to put our hands on it. And we did it immediately. And I have to say, I think Kris did about 30 days of work on this funding. Good 30 days. He worked really hard, and we had to work during the break to get it. And we got it across the line. I mean, imagine if you had a banker on the day that disappeared on holiday and didn't do it. And we worked all December, I think, during the Christmas holiday and whatever, but we got this building and it's actually worked well for the client. We've also managed to get some good lending for other clients as well for commercial banking. Now, I have to say, Kris is well connected in private banking. Now, Kris, what are some of the requirements to get into private banking? But you have to go through. Yeah.
It's generally income based, so income and to a lesser extent kind of network, kind of liquid assets outside of property and stuff like this. So it changes a bit from bank to bank. In most cases, it might be an entry income of say 300K, something like that. But if you can get in, the rules basically change, and it's a bit closer to old school banking, where we can often get away with stuff that we couldn't get basically through the normal parts of the bank. And a lot of, I suppose, the part I've always seen my job is to find the bankers who will write the deals, because you might look at a bank and think they're all the same. That it doesn't work that way. You've got some bankers who see themselves as a credit prevention unit, I suppose is how I'd refer to them. And you've got other people who are basically hungry to write business. And private banking, if you can get in there, not always. Again, there's good bankers and bad bankers, but quite often, if we can, we'll fit clients into private banking because they can get a lot better service, a lot better products, all kind of things. There's another client of Sal's that we've been working on for 18 months. Guy earns a very large amount of money. And because he basically kept paying off his mortgages, the commercial part of the bank didn't want to deal with him. And they kept basically restructuring him because he, for quite a while, he wasn't having any debt. We've got him restructured in the same bank through a private banker who understands that their job is to look after basically that person. We still have the relationship. And so we'll basically work between the client and the private banker over time. But they find that private banker a hell of a lot easier to deal with than basically being shunted all around the bank like they were previously.
And some of the advantage of private banking as well is like, for example, if you need 200-300 grand facility for the day, they're quite good at it, isn't it? They'll give it to you quick. Okay, here you go, buddy, use the money. So those are the beauty of having. And again, Kris is well connected to these private bankers. Now, this other thing that we want to talk about is trade finance. I've seen trade finance on, clients and their businesses where their family home is secured. Now, that should not be happening. We should not be securing our family home into trade finance. So if you've got that going, you should have a good chat to your bank and say, undo that, please. Do not tie my family home into trade finance. Because the banks actually charge you to give you trade finance. They understand the risk. They charge you more money. So they should not be taking a family home. They should not be double dipping here.
Banks are very good at trying to grab property assets. Probably the difference in regards to how we approach it and how GRA approaches it to the banks. Banks will always try and grab as much as possible. We try and give as little as possible. If that makes sense.
Well, that's one of KPM's rule and our GRA rules.
Yeah.
We do not let banks take everything. We don't like it. Then we got business finance. So you got your business, the banks have been given clear instruction from the government to help businesses grow. So there's some easy lending coming for businesses, right? Again, you don't want to be cross-securing your family home. You should be cutting a deal with them. And a couple of my bankers, I've dealt with them, and they've clearly told me the rules. We don't need to include your family home, or we don't need to include this. So they give me all the rules on this, and Kris actually tells me the same thing. So again, if your business finance is tied in with your house, you should have a good chat to them or talk to someone like Kris. And then we have asset finance. Again, asset finance should not be tied to your family home, guys. It should be
Yeah.
only tied to that particular asset. You know, the banks are doing you no favor by lending money. They're lending you money because you're paying higher interest rates, right? So it goes both ways. So they should not be getting extra security. Sorry, Kris, go for it.
And just probably one more comment on the business finance aside from Sal. I mean, there are times where you may have to give the home as security, but one thing I don't like is when people give the home as security, and let's say you've got a trading business. Now, when I say a trading business, that's not a holding business, so that could be a mechanic workshop, a retail store, anything like that. And so standard process, if you go to the bank and say you want to basically borrow the money, most people then borrow the money under the name of that business. Basically, banks will generally then immediately take guarantees and hook basically the business into the home. And secondly, because it's a trading business, they'll try and charge you much higher interest rates. So again, what we'll try and do is basically borrow the money generally in personal names, and we work very closely with GRA who can tie it back behind the scenes. That basically then means that the business is not hooked into the home, and because it's personal names, we can generally access residential mortgage rates rather than the higher business rates as well. So the structuring side becomes really important for both basically asset protection and price. So a quick comment on non-banks. I'm not going to really talk too much here. All I'll sit there and say is, I suppose, something we've noticed over the last 5 years in particular is banks have got more and more regulated. Non-bank lenders are basically flooding into the country. One of the biggest changes is as the banks get more regulated, what the banks are now starting to do is actually lend directly to the non-banks who can do things that the banks can't do. So obviously that sounds rather stupid. So Westpac, for example, provides a large number of funding lines. For example, there's a property trading business we deal a lot with called Base Corp out of Hamilton. They can do all kind of things that Westpac would basically never do, but the money's coming from Westpac. And there's a large number of other non-banks basically in that space. So this is a quick example of a client who we've been working with recently. And this is before the updated news potentially of a move to 80%. So the client owns a investment property which is valued at 860K. They've got an existing mortgage with ANZ of 584. Keep in mind that until the recent announcement of the potential to go to 80%, the maximum the bank can lend to is 70%. So 70% of the property valuation of 860 is 602. The existing mortgage is, of course, 584, which means the client's only got 18K of equity. Based off using bank finance, they can't do anything. So what we've done is, and we're literally right in the process of this at the moment, is refinance to a non-bank lender at 80%. So 80% of the 860 is 688. 688 minus the existing debt means the client's got 104K to use, and they signed up a property for the absolute maximum they could go to on Sunday for 520K. Now, the plan here will be to get them through the non-bank and then probably get them refinanced back to bank as soon as we can. But this is a classic example of basically using a non-bank lender where we'd have no chance of getting bank funding for a client like this. And I expect moving forward, more and more clients to basically have to use non-banks to get transactions across the line. So quick comment on interest rates. This is a very rough kind of table on where interest rates are at the moment. It's a bit of kind of up and down with different banks. You've got some banks basically like SBS, for example, is offering a 3.99. That's only basically for first home buyers and things like this. They won't offer for investors at all. So this is a bit of a rough guide basically for rates in the investment space. What I wanted to basically quickly comment on was I think we're pretty much guaranteed at the next official cash rate review, which is 26th November, we'll get another 25 basis point drop, which will take us down to 2.25. If you want to kind of focus on good commentators, a lot of you probably have heard of Tony Alexander. The guy I actually think has probably been best in the last 5 years, actually a guy called Jared Kerr, who's the Kiwi Bank chief economist. I think he's been basically kind of calling it very accurately. And he thinks that we'll have the 25 basis point cut in a couple of weeks' time. Remember, we're also got probably about a 50% chance of seeing a further cut down to a 2% OCR at the February OCR review. And I think where that's interesting is that kind of cut then potentially starts seeing 1 year rates, maybe starting with a 3.99 or something like that. So I think the Reserve Bank's really now starting to recognise that they bought interest rates too low back in COVID. They've now basically bought them too high. And they now basically need to kick some confidence into the economy. And so they're kind of, really going to make some moves to kind of get that going. As I said earlier, the moves to take 0.5% cut and do some relaxing on the LVR area basically shows a plan to get things going. And just another couple of things. I mean, the unemployment rate nudged up again last week, and I saw basically an article from ASB today. One of the big things the Reserve Bank does is it surveys both households and businesses to get an idea of where they think inflation's going. And basically, like, for example, businesses thinking they're going to have to put their prices up and things like this. And this is one of the main mechanisms they use to keep an eye on the OCR. At the moment, the indications are that inflation is not going to be creeping up and should continue to go down. So
Kris, back on interest rate, just quickly.
Yep.
I think in a year's time, if you can go back to your numbers there, Kris.
Yep.
I think in a year's time, those rates might be 1% down all the way.
I don't know if we'll see that far of a drop. Keep in mind with interest rates that the official cash rate mainly affects the short-term rates. So float 6 months, 12, 18 months, it doesn't really have much of an influence on the long-term rates. What's happening over in economies like the US more influences the long-term interest rates. And I don't know, I don't personally think we'll see a 3.995 year rate. Trust me, if we could, I'll be happy and I'll be grabbing it immediately.
What my plan is to, and I think I'm going to get it next round, is I've got a few of my loans sitting on 6 months at the moment.
Yep.
And my aim is to go, as soon as it goes 3.99, I'm going to book it for 5 years.
Yep. Yeah, I mean, at the moment, most of what we've been recommending is, I think if you want the best price for the next 12 months, it's probably fixing for a 1 year. But what I've actually been doing is the exact same thing as Sal, where I've been kind of fixing for 6 months because I think the low point in the interest rate cycle might be in the first 6 months of next year.
Yeah.
And so kind of having your rates come off in that first 6 months, then you can come off and you can probably hedge, potentially fix for longer, as Sal's saying. Both Sal and I fixed a lot of debt for 5 years at 2.99, and we're very, very thankful we did it. It saved a huge amount of money in doing so. I wouldn't fix for 5 years at 4.99. I know Tony Alexander's basically said it's a good move, and I wanted to say I could be completely wrong in a few years. Trying to pick the tops and bottoms of interest rate cycles is very hard, but I personally think we can maybe do a little bit better than 5 years at that rate.
Yeah, absolutely. And I'll run and I think if you've got good cash flow and you can pick up 3.99, try and obviously make the same amount of loan repayments, so you can obviously pay your loan off faster with a lower interest rate, because that's when you want to hammer your loan down is cheaper interest rates. Sorry, Kris, you can move on.
So just a quick comment as well. A lot of what we do for clients is what we call a break fee analysis. So this is an example just for a client we did, it must be a few weeks ago now. And so effectively, a lot of you might have interest rates still, fixed, maybe with say 12 months to go. So often what we'll do is this kind of formula here, where we can sit there and go, okay, we can look at basically the interest rate you're on. We can basically, the loan amount times the interest rate through to the rate expiry, and you can kind of get an idea of what the interest costs are. Then we basically compare that with, you then need to basically then compare that where if you were to break, move to a cheaper interest rate, and then add the break fee on. So you basically are comparing running out your interest term your fixed rate interest term as is versus breaking now and we're in the break fee. And so you can see here with this client here, basically the ASB loans, they would have ended up kind of minorly better. This client here with B and Z, they were going to be about 2.5K worse. This particular client overall, because they had some floating mortgages as well, and we were refinancing them, and they were getting about 22K of cash contributions. So obviously 22K of cash contributions minus basically the break fees, they were still ending up well ahead. So that's basically it for me. But if you want to have a meeting, a review meeting, it's a good time to kind of understand kind of where you're at. One of the big things I say to a lot of people is kind of get a good understanding of how the banks are looking at you before you go take on debt. So we can do a good review where we can show you exactly how the banks look. We've got access to their loan affordability calculators. So what we'll tend to do is kind of give you a good indication on that side. And then I think Sal might have referred to this earlier, especially if you're wanting to invest, strongly recommend you get pre-approved. We're seeing so many people who are not getting pre-approved, they find a property and the banks aren't always the fastest. And so sometimes you might miss out on deals. So get yourself ready so you're in the best position to move forward.
Kris, if you can go forward, one more slide. Sorry, I think it's about to come up. So, guys, before we're going to answer some questions now, so get those questions coming. We're going to go through them. So, here's some of my recommendations, and I give this all the time, and I've been giving this for years and years. And I'll take you back, 7 years ago when we started presenting, or 8 years ago. We always say that people go, "I wish I started investing 10 years ago." Right? So it's never right time to invest. Get in there and start doing things now. Like, some of my recommendations are don't do nothing. You act sooner than later, right? You got to act now. Like Kris said, there's 80% lending coming in, right? You want to be down Kris's throat tomorrow and say, mate, I want you to put my application in first. That's what you got to do. Get in there quickly, get your applications and get it going. We want you to do well, right? Don't use lack of time or fear as an excuse. That's quite important, right? We don't want to be using lack of time or fear as an excuse. Now, every time people say, I don't have time, I go, pick up your phone, check your screen time. On average, we spend 3 hours a day on our phone, right? So you don't use time as an excuse. Draw yourself a timeline with targets. Remember the roadmap we were talking about, where you are now, where do you want to be in 10 years, right? So that's really important. Draw yourself that timeline and obviously talk to your spouse as well and surround yourself with the right people, right banker, right accountant, right lawyer. These guys are so important and we can get you all that because we know who they are. And think of long term when it comes to property investing, right? No one's become a multi-millionaire overnight doing property investments. It's taken them 10 years, but when they get there, they're so grateful that they did it. Like you said, 95% of my client base and probably Kris's client base are multimillionaires and they've all stuck to property investing, right? It's always a cycle, right? And once we come out of one cycle, we go into another cycle and there's always growth. This time around, I think we're going to have low interest rate for a long time. And so we should use that opportunity to buy good properties, pay off our debt faster if you've got cash flow and do things like that. So guys, we're going to start answering questions shortly. Now, I always talk about this as well, like please get your insurance checked on your property, right? We're coming through, so we're looking at a lot of clients who bought property 10 years ago for 400-500 grand. They think they're insured for 400-500 grand, but their property is probably 1.5 million now. So please get your property insured properly. We use a company called Initio. They can give you a price. Put your property details in there. They'll give you a price. And if you say you're part of GRA, you get a discount as well. Also, guys, very important, you get your personal insurance sorted. We have a funny guy called Steve Monroe. And if you do email him, so that's his email address, that's his website there, riskdirect.co.nz. If you get hold of him, get him to do a free review of your personal insurance. Very important you have the right covers in place. We always promote, well, I actually think personal insurance is equally as important as investing in properties. Because if you have the right cover in place, and touch wood, you never have to use it, but if you do have to use it, it's there for you. It's same as having a house insurance, right? You hope you never have to use it, right? But it's there if you have to. So very important page, guys. Here's a photo. Take a photo of that and contact those people. Get it going. You don't have to do much. Email them, send them all documents, say, can you review and come back. Now, sorry, I was going to go here. So before we wrap up, here's our contact details as well. I mean, if you fill out the form, you need access to Kris. We'll pass your details on to Kris and Kris will contact you. If you're not sure who to contact, just email Amy and she'll put you through to the right people. Now we're going to start answering questions, guys. Sorry, we're running a little bit late. I told Kris it's going to be 90 minutes.
You're right. Sorry.
Yeah. So now we're going to, Maggie will read all the questions out and we're going to answer them as we go.
Wonderful. Okay, from Travis, I've heard that having a credit card can seriously impact your lending ability. Do you recommend that clients close a card before applying and just reopen it after settlement?
So one thing which is, so historically what happened is if you paid your credit card off or didn't use it, the banks just basically would ignore it. Something which happened a few years ago is now the banks will take a percentage of the limit and basically load that as a monthly expense. So as an example, let's say you've got a 20K credit card limit. Some banks will take between 3 and 4%. Let's say 4% of 20K is $800 basically dollars a month. They'll load that in. You've probably just lost the best part of $120,000 in mortgage borrowing capacity. Now, it's worth knowing though that like for a lot of you, your loan affordability with the banks may be fine. So don't just go start running out there and closing with your credit cards. because you may not need to do it. Again, it kind of goes back to that review option basically that I said. So generally what we'll do, a lot of clients, we can sit there, run you through a bank affordability calculator. We can sit there and have a discussion with what you're wanting to achieve, and then we can recommend if that's something you need to do or not. I wouldn't just recommend you start running out and just closing everything in case, in case that's something which you're going to need to do.
Brendan asks, what are your initial thoughts on Labor's proposed capital gains tax and what knock-on effects do you foresee?
Well, I've personally seen every time Labor's talked about capital gains tax, they've either lost election or they've handed the election over on a golden plate to National. And I think they've done this time. They've given National a big power. And as a result, I think, National will get back into power. Now, if Labor did win and there's capital gains tax coming, what will happen is we'll have a start date from a certain starting point. They might say from 1st of January 2028. Any assets that you own will be, you'll have to pay capital gains tax. What will happen is you will have a chance to get your assets revalued, right? Move your shares of your business into another entity at market value. And what happens when you're allowed to do all that? People will inflate the value of everything, right? So I think people will put safeguards in place, so they will be protected. I think we will find ways to mitigate capital gains tax, and I think will come into play. But with any party coming to talking about capital gains tax, I think they need to be careful because Kiwis don't like capital gains tax because they understand that Labor has been wasting a lot of taxpayers' money. If capital gains tax, I don't have a problem paying capital gains tax. Kris doesn't have a problem paying capital gains tax, provided you build roads, you build schools, you build hospitals. I'm happy to put my money into those kind of assets, and they've got to be world-class assets, right? But just taking our money and putting it down a drain by paying consultants, something like $900 or $1,500 an hour to get stupid reports when you don't act on. I think this is what Kiwis have enough of. So as a result, I probably would not prefer capital gains tax under Labor.
Sam asks, says the majority of my assets and lending sit with a main bank, which is already at the maximum allowed under the Reserve Bank DTI limits for residential lending. Also similar amount with non-bank lenders with high interest. What are my options to reduced interest rates?
I'd be interested if it's truly DTIs, because I understand what's fully come in with DTIs, but DTIs don't really apply to existing lending. It's more basically for new lending. And also, so far, we haven't really seen DTIs biting at all. So I don't know if that's who you're using, the bank or another broker or anything. Maybe that's not properly being explained. Banks traditionally have worked off what's known as a UMI or uncommitted monthly income formula. And we've found that has been harder than basically the DTIs in regards to holding people back. It's hard to kind of give too much information without knowing particulars in regards to your position. Yeah, I mean, the non-banks, one of the big differences between some non-banks we deal with and banks is the way that banks will calculate your overall debt, or mortgage debt, I should say, is they'll basically, in most cases, look at all of your debt. They'll assess it all on a principal interest basis, even if you're paying interest only, and they'll assess it on test rates, which at the moment are basically just under 7%. So let's say you've got $1 million at a 4.5% interest rate. And let's say that was interest only, you'd be paying $45K a year. But when it comes for the bank to basically assess your affordability, they're assessing that $1 million on, let's call it 7 on P&I. And the calculator says you're basically, that cost you is 80, even though you're basically only paying 45K a year. So one of the big differences is we've got some non-bank lenders who will work on actual payments rather than these higher test rates. So the bank's going to basically assess you as paying 80. The non-bank lender will basically assess you as paying 45 because that's what you're actually paying. That 35K basically difference could be the difference between you buying another property or not.
Perfect. And I reckon, Sam, you should get hold of Kris to review your affairs and see if he can guide you through to a better bank or better rates. There you go. Maggie, what's the next one?
Samuel asks, is your second tier 20% LVR primary 20% investment property, sub 5% interest available. He thinks it might be 4.5%.
No, so the main non-bank lender which I use, just so I might be confused here, I used an example earlier about a guy who was currently at ANZ, and because he wanted to buy more, he couldn't, because basically the banks couldn't go to the higher LVR. The non-bank we're going to there, I think the interest rate's about 6% there, so it is higher than basically bank rates. But again, keep in mind what we're going to be trying to do is probably fund them through the non-bank lender, then look to maybe use that dollar for dollar exemption to get them back to a bank. Obviously, back to a bank is all the rates you basically saw on an earlier slide. So we've told the client, look, you need to basically look from a worst case scenario, these numbers here, it might be about 6%. He's happy with the property deal, all that type of stuff. But our plan will be everything we can to try and get them back to a bank as soon as we can.
James says, for a dollar for dollar refinance, what's the maximum LVR new bank can take for an investment property?
So my understanding is with the Reserve Bank, they've basically said it's exempt so the banks can go to what they want. In our experience, we've seen the banks really limiting it to 80%.
Sashi, do you have a Facebook group or something similar where you share knowledge or good property deals?
No, we don't do that, Sashi. So what you got to do is probably get a hold of someone like Maggie or Thin, and we'll be able to guide you through some of the property finders. But firstly, I mean, before you even want us to help you find a property or guide you through a property finder, you've got to make sure you've got your funding in place, because otherwise we'll all think you're wasting our time. Because we'll be finding all the deals, but you can't do it because you don't have finance in place. But if you've got finance in place, we can definitely guide you through to who can help you find a property.
If you're looking for knowledge and education, then of course we have Property School,
Yes.
or Matthew's Property 101 book.
Property School for the cost is an amazing course. Yeah.
And I must say it's probably just as well we don't have a Facebook group, since they like to close them down, don't they?
I saw that. 70,000 people gone.
Yeah. Sam asks, are all the banks reassessing LVR when a fixed loan is rolling off, i.e. if not under 80% LVR, adding a margin to the standard rates?
So what the banks will tend to do, I think I understand your question, where you might have bought a property at the peak of the cycle. Let's say you had it at a higher LVR, and let's say it's come up to your fixed rate. What the banks will often do is run what's known as a desktop valuation. And if it's above 80%, then they're going to maybe try and charge a margin and stuff like this. So then you have to basically look at it and go, okay, do you think you can maybe ask the bank for a copy of the desktop, depending on how well you know your market, especially if you've renovated your property. Quite often the desktops can be under market value. So it may be a case of adding up the cost of, is it worth getting a registered valuation to show that the LVR is 80% or below, which will basically get you standard interest rates. But it's generally, in most cases, it's this desktop valuation system, which will be putting you above the LVR threshold, which is generally 80%, where they're going to maybe try and charge you some low equity costs.
Yes, asks, what can you do if you want to get into investment properties?
Okay, so the first thing you need to do is, if you want to get into investment property, is to talk to someone like Kris, see what funding you can get in place. Now, let's say Kris might say, hey, you don't have enough deposit or enough income. I suggest the next thing you should do, Jess, is talk to some good friends or family members that you can do syndicate investing with, or joint venture. And that's how you get started, because there'll be other people in the similar position where they've got some funds, but they haven't got enough. So together you can put your funds in and go to someone like Kris, who can probably take you to a main tier lender and get you going with investing into properties. And once you have your pre-approval in place, it's easy to find a property, because then you know how much you have to spend, what you need to look out for. And
yeah. Sorry, sir.
And if you need any help with analyzing the property, you've got Maggie and Thin that can help you. They charge $250 plus GST an hour, and they're very good at what they do. If they find any issues with the property, they'll tell you, or if they can't solve a problem, they'll refer you to the right supplier who can resolve your problems. Sorry, Kris, go for it.
A lot of what basically Sal and I, we often providing advice in kind of joint venture type situations. So it's not abnormal to basically see people who might have, you know, a good income and they've got a mate who's basically got the deposit and that type of stuff. And they basically want to combine forces to basically do things. And so often what will happen is I might have an initial chat to go, okay, what's the best way to make the funding work? And then we'll basically work with GRA to make sure the structuring works. Because often if you're working with friends, family, all this type of stuff, a lot of people don't have the hard discussions before they go into a transaction. And you basically want to make sure that if anything goes wrong, you're not basically ruining your relationships. So yeah, as GRA is very, very good on those structuring conversations, you'll find basically people like Sal and Maggie and Tham will have all been involved in multiple joint venture type deals themselves. So they know the best way to put those deals together.
And of course, if you're starting out, then GRA's property school, so you can find the information on the website.
Yeah.
It's a great place to start. James, if I invest with friends for a long-term hold, what would be a good setup in terms of entity, and what would be a fair way to allocate ownership on the basis of what they bring to the deal, e.g. equity, deposit, hands-on time renovating, income servicing?
So that's quite a broad question. Now, there's a lot of moving factors here that we need to look at. Firstly, like, you know, who's the funder? If one of the friends is putting the deposit in, that friend would probably want 50%, and that's fair call because they're putting the deposit in. If you're not the funder and you have to do the renovation work and everything else, so you have to put your time in, right? So it all comes down to what you guys agree, you know, and what percentage you agree to split. So based on that, then a company structure could be set up. It depends again on your circumstances, but I'm just going to say a company structure would be probably relevant. And we'll probably look at 50-50 unless you guys agree between yourself. You know, one should be 70, one should be 30. That's fine. Now, what you got to remember is the person who puts the deposit in, the equity, it doesn't mean the other party that hasn't put the funds in will be entitled to the deposit funds. No, that's what we call a shareholder's current account, right? The person who puts the deposit is entitled to the money back, right? They'll get the money back. Oh, and if they want to charge interest, they have the right to charge interest as well. And this is something you should pre-agree before getting into a deal together so you don't end up fighting. But again, if you are going to do something like this, James, suggest you probably catch up with GRA first and we can put the right documents and the right structure in place prior to buying something.
From Sam, what are your thoughts on investing in residential property or commercial property? There's naturally pros and cons, but as a residential investor, commercial is piquing our interest more for various reasons. Keen on any thoughts or experience from the guys on the current market.
Well, I can tell you this now, Sam, everyone's staying away from retail properties. Yeah, I mean, I don't know what's happening in the retail industry. I think this might be the end of retail businesses. I'm not talking about the malls. I'm talking about more like Broadway. If you walk down Broadway in Newmarket, 90% of the shops are sitting empty. And they've been like that for the last 4 years, right? And I've had the same story in Wellington. I've had the same story in Aussie. All these shops are shutting down. People are buying online, whatever this new generation's called. What are they called? I can't keep up with them. Gen
Neither
Z,
can I.
Gen Z or something, whatever they're called. They do online shopping. You know, everything is on just hit a button and it's delivered, including their food. You know, so that's what's happening here. So be careful with that. Now, I can tell you this: heavy commercial properties, so industrial land, they are actually selling well. Everyone wants them, and big development sites, people want them as well. The only disadvantage of going to commercial is you have 15 years P&I, so which means 15 years of paying principal and interest off, which means even if you're making profit on the books on your rental income, cash flow wise, you might be going negative because you've got to be paying your loan off faster. So if you don't have enough cash flow, you'll be going broke very quick. So whereas residential properties, the advantage is Kris can get you a 5 years interest only mortgage and a mortgage that's on a 30-year loan repayment term. Now, let's say what happens is 5 years interest only period is over. Now you've got to pay your debt off over 25 years. Kris might be able to refinance you and take you to another bank where you can get interest only for the next 5 years. Now, I understand, Kris, some of the banks are offering 10 years interest only.
Yeah, two banks are back offering 10 years.
Wow, like what a great product, sorry. what a great product to get, and again, get hold of Kris to get products like that. If your cash flow is tight, you need to go on 10 years interest only. Get hold of someone like Kris and get it going. Those products are amazing, and they'll help you, which means you don't lose your property. You're not forced to fire sale because you can lower your repayments down. I hope I've answered that question, Mickey. What's the next one we've got coming?
From Matt, what is the real difference between revolving credit and offset account and overdraft? Why does each bank offer them all, I think?
So a revolving credit is like a large overdraft. So if you think of a large credit facility where you've got like a limit, let's say it's $500,000 for the sake of it, and let's say you owe $100,000 on that facility, you're not paying interest on the 500K, which is the limit. You're only paying interest on the balance, the 100,000. So the reason, like there's parts we like revolving credits, you can offset. If you're sitting on cash, you can throw the cash into the facility to offset interest. It's also handy, for example, when we've gone through pretty significant downturn like the last few years, having a facility there where you've got access to the money, but you're not paying for it. So with a lot of our probably kind of larger, more established investors, like just having those facilities there that if they had a bit of a cash, problem, they've got access to those facilities which they can basically draw on. So that's, I suppose, overdraft, revolving credits. Just think of them as the same thing. Every bank offers them. Offsets, Kiwibank, BNZ, Westpac are the only banks to basically offer offsets. And again, that's basically a linking of different facilities. So a revolving credit is just one account. A offset could be a linking of like BNZ's facility, total money. You can actually link up to 50 accounts. And let's say you had 50 different, and you can also do weird things where you might have, for example, a parents who are sitting on cash. They don't want to give their kids the cash because they're worried they're going to go run off with it or spend it on something bad. But they can, in some cases, be linked back to the kid's mortgage to effectively offset the interest costs. So offsets are effectively a number of facilities. Let's say you had a $100,000 floating mortgage and you had a $50,000 savings account and a $20,000 check account. You could effectively offset that and you'd only be paying the interest on the $30,000 basically remaining.
Great. Travis asks, with the revolving line of credit, what limits are banks offering? 500,000 or 600,000?
Great question. So that's kind of alludes a bit into one of the things I mentioned earlier, that the banks have definitely toughened up a bit. So again, when I was first working with Sal, 15 plus, even longer than that years ago, we were finding often back then, basically we were getting $1 million facilities. Since then, and I think the Reserve Bank has played a bit of a part in this, is they've tightened up people's ability to get them. So you look at a bank like ASB. ASB used to do $1 million facilities. They're only doing 200K now, basically for most clients. ANZ, we used to be able to get $1 million facilities through ANZ. They're maxing out at 350. So it's kind of a bit of case for case. There's a couple of banks where you can get larger facilities in some cases. Yeah, but so it's kind of from bank to bank. Yeah, there's some banks we can still get $1 million facilities at certain parts of the bank though.
Question from Shane. What is the revolving credit rate of drawn down money? Floating rates or slightly more? Monthly fees of undrawn funds? Do these costs vary much between lenders or non-bank lenders?
Yep. So most non-banks will not offer revolving credit facilities. It just doesn't tend to be a facility which is offered in the non-bank space. With the banks, you're either paying a floating rate or you're paying maybe, for example, like some banks might charge 0.1%, for example, above the floating rate. So you can still get all the discounts and all that type of stuff, but often it might be kind of say 0.1% more. Some banks might try and charge a monthly fee, basically for having the account as well. Again, we've got some banks in certain ways we can potentially, some facilities we can get rid of the fees, some we can't. So the fees in some cases might be, $10 or $12 a month or something like that to have, and again, depending on your situation, if you've got a facility large enough to offset the interest costs and have access to the cash, it's not a huge amount of money to spend to basically have access to that kind of facility.
Will the undrawn portion of a revolving facility become restraint for new lending?
Okay, so I think if I'm asking the question correctly, is let's say you've got a $1 million revolving credit for just a big number. Let's say you've only got $100,000 basically owing on it. The banks, when they're basically testing you for further borrowing, are going to test you on the $1 million limit, not the $100,000 owing. So obviously that could basically hit you in a negative way for your borrowing capacity, or that type of thing, because you've got a large facility. It goes back to kind of what I said is, you don't need to talk to anyone. I'm not saying for a second anyone should do this, but literally you could go blow the whole thing at the casino, because that's how easy it is to basically access the money. So the banks will treat the facility as if the whole thing is basically drawn down, even if basically you owe nothing on it. And just to, I think, reiterate, I think it was something on one of the previous questions. There's the residential kind of revolving credit. Sometimes when you go to a business or commercial, you may get what's known as a line fee. So this is more a little bit different, where they might charge in commercial banking, often there might be a larger fee, but in most cases what we've been discussing tonight is more kind of like the retail business banking part.
Sam has 4 rental properties with Westpac. Then he says rest 3 rental properties with Liberty. So perhaps he means another 3 rental properties with Liberty with high interest rates.
Yep.
Sam, if there's a question, do you want to type that in?
I think Sam should definitely make an appointment to see Kris, because I've seen a few of your questions. I think Kris might be able to help you through, you know. Looks like Sam's paying some high interest rate, Kris, so we can.
Yeah, so this is where we look at your overall position.
Yeah.
It can be things like, obviously don't want to get into this too much now, but there can be things with your bank mortgages where we can extend those back out. So I mentioned before on how the banks assess servicing, where they look at your mortgage debt, they look at it on a higher test rate on P&I. One of the things I didn't mention is that they assess it on your residual loan term. So let's say you're taking that $1 million out on a 30-year term 15 years ago, they're going to assess you on the remaining term, which is 15 years. So often what we'll do there is we'll go to clients and go, okay, we can extend your term back out, basically, obviously with a longer loan term, that basically reduces what the bank sees as a required payment. That can improve your affordability. So this is where we'll do little tweaks. I think it might have been one of the first question we had was around credit cards. We'll look at things like credit cards. Okay, we might kill credit card limits. We can extend loan terms out. What are the tweaks we can do to someone's position if their affordability is holding them back? So it's kind of a case, what do we need to do to basically kind of be able to, for you to be able to kind of refinance that Liberty stuff back to a bank? And that's something where we need to go through the full analysis to be able to do that.
This asks if banks will loan 70% of your current equity for an investment property with a 20% deposit.
I think they might be a bit confused. So the rule up until this potential change on 1 December is if you're buying an existing investment property, so that's not a new build, you've got to basically put in a 30% deposit. So $1 million property, you've got to put 300K in. Now that could be cash, or if you've got sufficient equity, we might be able to tap into the equity in your property and to enable you to basically do that. But let's say you don't have any other property, you're wanting to buy this $1 million property, basically you're going to have to put in a $300,000 deposit. What we're basically saying is that some of these rules are potentially changing come 1 December, that it may only be 20% or 200K. So obviously that can be a large difference for people.
Logan, what's the best way to maintain or secure lending if I plan to leave my current employment and move into full-time property trading?
Now, Kris and I don't like that.
Yeah, no.
We really, Logan, you need to have a good chat to Kris and I. Probably you need a proper asset planning advice to make sure your assets are protected if you're going to go down this track. And Kris will look at it as well. Let's say if you are going to do this, what we got to do to make sure is your family home is protected, overdrafts are in place, and then what do you need in a year to live off? You know, some people have 100 grand a year living cost. So we've got to look at that and see how long your funds are going to go for. Now, if you are going to become a property trader full time, Kris, will probably you have to use second tier lenders, not first tier, because obviously they look at your income serviceability. So you will be the second tier lender and Kris will organise that for you.
Yeah, I would sit there and go, for most people, trading can look, really sexy at times, but a lot of people won't see the, it's not, there's people who have losses with trading and stuff as well. We obviously see the good, but we also basically see the bad. And for most people, I'd be sitting there saying, you've got to maybe be willing to work really hard for the next kind of 12, 24 months. Well, I'd be saying you keep your job, basically get some trades across the line, then go back and look at those trades, and I can basically show you the non-bank costs, which will be higher, then basically put the non-bank costs into those deals, and then see if you're still making a sufficient profit overall for you to have been happy to leave your job.
And yeah, of course, you're losing half the profit you think you're making to tax and sale costs. So it's quite costly, isn't it, trading? Whereas there could be a solution where Logan would stay in employment and use somebody to manage the project, the renovation project, which would work out more cost effective, wouldn't it? Best insurance to use for property trading.
Now, there are commercial companies that do commercial insurances, and we use, the name just went out of my head. No, we use one in Hamilton called, Then, do you remember the name?
Frank Insurance.
What is it?
Frank.
Oh, Frank Insurance. Yeah, we use Frank Insurance, and so they can put you into this kind of facilities in place. We use Frank Insurance on a daily basis because we build houses as well. And they do a good job. We like them. So yeah, suggest if you need a connection, Logan, email Thin or email Amy, and she'll be able to guide you through to Thin, and we can do an intro.
Kyle asks, what options for finance are available for developments now? Existing land can now be subdivided.
So it comes down to, if you're developing to sell, then it comes down to, are you willing to get pre-sales? And most people at the moment are willing to get pre-sales because it's hard to pre-sell new build stock at the moment. And so in most cases, then you might need to be looking at the non-bank market. Now, the non-bank market is more expensive than the bank funding side, but often you can do more. So you've got to figure out, there's dealing with banks where the funding cost will be cheaper, but it will be a lot more onerous in regards to like requiring quantity surveys, potentially requiring pre-sales. There's a lot more boxes to basically tick through to these specialist development funders. And these guys who own the company tend to be large developers themselves. And so because of their development experience, they don't require a QS because they can go look at a project themselves and they tend to be able to understand the numbers. So quite often we'll see there's some developers who are very, very good at running projects well under what quantity servers believe it can be run for, and they often can't get basically bank funding. So quite often they'll go basically through these specialist development funders. Higher financing costs, but the funding's a lot easier to get. As I said, you don't have to get the pre-sales. Often you don't need valuations, quantity surveys, all this type of thing. So it comes around to the original, the project and what you're willing to give up on to an extent.
Dan says Labor are proposing to reinstate the removal of interest deductibility on investment properties. Does this make you less inclined to continue purchasing, given the uncertainty hanging over us?
Well, I'll tell you this. Labor will probably reinstate, if they came into power, reinstate some of the old rules back in. But if you are into social housing, you will get deductibility because that was one of their rules. If you do social housing or if you build brand new houses, you get deductibility as well. So there will be incentive as well. So I don't think it'll be all bad news, but there will be incentive as well. The thing is, if Labor crashes the market like they did last time, the rents only go up. Because one of the things Labor does is they bring a lot of people into the country, right? So when you bring a lot of people in, they might increase the refugee quota from 1,500 refugees a year to 3,000. Where do we house all these people? Suddenly we'll be running out of homes, right? So Labor does make immigration easier, allows a lot of people to come in. So it won't take long. Within 12 months, we'll have shortage of housing under Labor. And this is what happens. So I'm not too worried about non-deductibility, but I do have to say, I definitely don't want Labor in power because I'm a far right, or probably middle to far right.
Joshua, how do you approach funding for off-the-plan new build investments?
Sorry, is that for, I'm presuming that's for you as a purchaser who's not doing the development but buying the end stock as an example. So where this can be a bit complicated is, let's say you're buying something off the plans which has 2 years to run. So this is where there can be a big disconnect at the bank side of things. So let's say I want to go build an apartment block down the road, and let's say I'm building a 10-story apartment block with 100 apartments. For me to basically go basically get my financing for that, especially through a bank, I've got to go get what's known as these pre-sales. So I'll go get those pre-sales basically, and then that will give me the ability to go do the funding. But for you as basically maybe one of the people who are buying the apartments off me and effectively one of my pre-sales, you can't get a bank approval for longer than 12 months. Now, for me to go do that development, that's going to take me longer than 12 months. So effectively what happens is, especially when we go through markets like we have in the last kind of couple of years, this is where you've got to be a bit careful, because people, and this very much happened back in the GFC, people got slaughtered basically, especially with this type of stock around the 2005 to 2007 market, especially places like Central Auckland. There was a huge amount of apartment stock came in. And back then you could basically literally lock down a pre-sale by putting $1,000 down. So a lot of people basically back then were basically putting $1,000 down, thinking these, property never goes down. And then what was basically happening is they're not understanding that they're liable, that you've basically got to complete the purchase, or otherwise the developer can effectively come after you. So, I mean, what we have done with a lot of clients in that position is sit down, have an honest chat in regards to their situation, where it's at now and any changes they're likely to have, get them pre-approved, and then continue to basically talk with them from the initial pre-sale through to basically when they're, obviously close to settling. But you need to be honest, especially if you're buying something. I'm looking at some land in Queenstown at the moment, which is basically I can put a deposit down, and it's basically settlement should be about 2 years away. Now, I'm obviously making, and this is what I do for a job, so I'll basically make sure that I've got the ability to basically settle. But that's one of the big things, is we've seen a lot of people commit to properties, not understanding that basically if they don't settle, they can get themselves in a lot of trouble.
Sam asks, with dollar for dollar, can you go from private lender to a main bank?
Great question. So my understanding is that when it was first put in, it was supposed to be only from bank to bank. Now, when you say private lender, I don't think a private lender, like let's say your dad was basically lending you the money, I don't think the bank's going to basically let you do that. But in regards to a official non-bank, we've been giving some official non-banks across the line. So a situation where you've had an official non-bank basically who's lent above the 70% LVR, so to 80%, and then we've used the dollar for dollar exemption, where we've basically refinanced from non-bank across to bank, if that makes sense. And that's been a way to kind of get around a couple of the LVR rules. So initially the fine print was saying that you weren't supposed to be able to do that. We've got a few banks who've been allowing us to do it.
What do you mean by having the finance in place?
Is that the pre-sale question?
Oh, it's just a question. Maybe they mean like, what do we mean by having finance
Pre-approvals,
in
perhaps?
place? Yeah, we talk about pre-approval. So you have a pre-approval in
sorry,
place.
Yeah.
That was a question, but I
So
think
just quickly on that, like banks look at two things. They look at you as the borrowers, and they look at the security property. Basically, get everything to do with you as a borrower. Basically, pay so your income, bank statements, proof of deposit, all of these things ticked off. So the only thing you basically should have to provide is maybe a sale and purchase agreement and maybe a rental appraisal. So that basically is a case of getting you ready. You don't want to get into a situation where you find the property and then basically have to access finance quickly. We see too many people lose deals on that. The best deals don't hang around. So you want to get in a situation that you're as ready as possible to make a decision really quickly.
Kris, do you help with commercial property investment as well?
Yep.
And Kris is well connected with the banks, with commercial property, well connected.
Yeah, I'll reiterate what Sal said. I mean, industrial is the main thing we're seeing at the moment. Wouldn't touch retail. In most cases, I wouldn't touch office space. So industrial, we're funding a fair bit at the moment.
It looks like our last question from Donovan. On from Kyle's question, how do the banks look at subdivision where it holds a property that has two houses on one title? I'm wanting to improve lending. Not quite sure what he's asking there. Perhaps he's got a property that with two houses on one title.
So if it's just a case you've got two houses on a title and you're looking to subdivide it, it'll just come down to, is there sufficient equity in the property to top up to cover the subdivision costs, or do you have other resources to cover the subdivision? I mean, that's quite common. Heaps of people basically do that. It's just a case of doing a top up generally against what equity you've got to fund the subdivision through to being two individual titles.
And especially with that 80% funding coming in December, maybe for a limited time or limited funds, maybe now's the time, Donovan, you should get hold of Kris and get that going. So you can be first off the mark and get your funding in place to do the subdivision. I agree with that. Two houses on one site, you got to subdivide because instantly you put a couple of $100,000 in equity. But if you don't know how to do this, Donovan, maybe get hold of Maggie and Then. They can run some numbers for you. And if it's a good project, then we can even give you the supply chain that we use for subdivision. I've got a good mate called Simon O'Connor, and he helps a lot of people with subdivision. I think Maggie forgot a question about gold investment.
Gold investment is not interesting to many of us, though many of us have noticed its significant recent increase. What is the message learning people should get from this?
Well, I've got a good mate by the name of Glenn. He's the one who does gold for our clients as well. So if you go on our GRE website and look up, I think his surname is Thomas, or Glenn Thomas. He's a lovely man. He'll tell you about gold. He writes about gold. He tells you where to buy, where to secure them, and all of that. So Brendan, he'll be able to guide you through and get you some discounted gold. He does a good job of it, and he's dealing with a lot of people around the world in moving gold around, and they're making some good money, some really decent coin lately. And I think gold will keep going up for a while. I was in India last year. I wasn't born in India, so I went to see one of my friends, and they have charts everywhere in gold shops. So in the last 50 years, where gold started and where it has been now. So yeah, the belief in those kind of countries, India, China, some of those Middle Eastern countries, is gold's going to keep going up. It's got more value than money. And I think that was our last question for the night. We've still got about 66 people there. Thank you guys for listening to us. And sorry if the presentation has lasted a little bit longer, but look, if you need to get hold of any one of us, just scan that and fill out the forms or email Amy, and Amy might get in touch with you as well. Ask for Kris or ask for GRA. We are happy to help you, and it's all about giving back here. So we like to promote and grow our clients. We've done it for the last 20 years. We look forward to doing it for the next 20 years to the point where Then has no hair left. We'll keep going. Then's recovering from a bad injury. He was playing netball. I know he's been written off for a whole year, so he can't move much. I mean, who breaks their leg or whatever he did playing netball? Have you heard of that?
It's ballet class.
Yeah. I've had females getting injured in netball, but they've been injured only for 3 weeks, not for 12 months. So thank you guys. Thank you for listening to us, and have a good night, guys.
Thank you, everyone.
Thank you.
Hey guys, bye.